So good morning, students. So whatever time you're watching this video, this video is still part of our receivable, but we are going to focus more on notes receivable. So what is a notes receivable? A notes receivable is a written promise, evidenced by a promissory note, signed by the maker to pay the company a certain amount of money on a specified date. So the person who makes and signed the promissory note is called the maker. The maker who promised to pay another person called the payee. So on the books of the maker, it records this promissory note as notes payable. Then on the books of the payee, it records the notes receivable. All right. And on the part of the payee earns an interest income from this transaction, from this promissory note, while the maker incurs an interest expense. All right, so this is where the notes receivable is started. When the maker makes a note or promissory note to pay a payee, to pay another person's, and on the books of the payee, it records a notes receivable. And the notes receivable earns an interest income. Now, we are going to focus more on the payee's book. Then let's go into the accounting of the notes receivable. So we have two kinds of notes receivable. So we have the short-term notes receivable and the long-term notes receivable. The short-term notes receivable is classified as a current assets, while the long-term notes receivable is classified as a non-current assets. Whether our notes receivable is classified as a short-term receivable or a long-term receivable, we receive two different kinds of a promissory note. These are interest-bearing note or a note that is non-interest-bearing note. Whether we classify it as a short-term or long-term, we receive a promissory note in two different ways. A promissory note that is interest-bearing note or a non-interest-bearing note. Let us see the difference between an interest-bearing note and non-interest-bearing note. So these are the differences between the interest-bearing note and non-interest-bearing note. So let's take a look at the interest-bearing note first. So the interest-bearing note has a stated percentage of interest. So the maker promised the payee to pay an interest. So on the books of the payee, it will be an interest income. Okay, so on this interest-bearing note, the principal is equal to the face amount. What is the face amount? The face amount is the amount stated on the promissory note. It is the amount the payee is going to receive from the maker. On the interest-bearing note, the interest is calculated as the principal amount times the interest rate. So whatever the stated interest rate on the promissory note, that rate is called interest or stated interest rate, or also we call it as nominal interest rate. Those two are the same. Let's take a look at a pizza. Okay, a pizza represents, for example, this pizza represents the face amount of the promissory note. The pizza represents the face amount. Whole principal is what you're going to get on the maturity date. Aside from the principal that the payee will get on the maturity date, the payee will get an interest. And on the books of the payee, it will be an interest income. So the interest will represent a small pizza, separate from the principal. So the small pizza on the books of the payee will be the interest income. That is your interest bearing note. All right. Non-interest bearing notes. The name itself says non-interest, so meaning to say we don't receive an interest from the maker on the life of the notes receivable. The interest is included on the face amount of the promissory note. So the pizza, which represents our face amount, the interest is included on the face or in the face amount. So if the pizza represents the face amount, a portion of this pizza or the face amount is your interest, all right? And the rest is your principal. How do we separate the principal from the face amount? Separate the principal amount from the face amount of the notes receivable using the present value. And the difference will be the interest. So this is your non-interest bearing note. How do we measure these notes receivable? Once we receive this promissory note from the maker, we recognize these 3 notes receivable at face value, or also known as the face amount. Long-term notes receivable, that is non-interest bearing note, we recognize this or we record this non-interest bearing note at present value. So now let's see the accounting of the interest bearing note in the non-interest bearing note. Alright, now let's get to know more of interest-bearing notes and the non-interest-bearing note. You initially recognize an account on the transaction date. Our initial measurement is on the transaction date, and our subsequent measurement is when the accountant prepares for the financial statement of the company on the financial statement date. Now, on interest-bearing notes and non-interest-bearing notes, we also have our initial measurement and our subsequent measurement. When we first encounter these transactions or receive this promissory note from the maker, how much do we recognize these transactions or this promissory note on our books? Initial measurement of an interest-bearing note. We initially measure this at face value or the face amount of the promissory note. And the subsequent measurement of this interest-bearing note will be the net realizable value. Alright, the net realizable value is simply the face amount less all the payments made by the maker. Let's say installment payments. We subsequently measure the notes receivable face amount minus any payments made by the maker. On non-interest-bearing notes, we have our initial measurement and our subsequent measurement. Our initial measurement will be at present value. And for the subsequent measurement will be at amortized cost. Let's do the summary on this. On interest-bearing note, this includes the short-term and the long-term notes receivable. So the interest-bearing note that is measured at face value on initial measurement includes the short-term interest-bearing note and the long-term interest-bearing note, while the non-interest-bearing note only includes the long-term non-interest-bearing note. The interest-bearing notes, whether this is short-term or long-term, initial measurement will be at face value and subsequent measurement will be the net realizable value. Non-interest-bearing notes only includes the long-term non-interest-bearing note. The initial measurement will be at present value and subsequent measurement will be at amortized cost. The short-term non-interest-bearing note. All right, so it includes the short-term non-interest bearing notes on this initial measurement of face value and the subsequent measurement of net realizable value. All right, now let's talk about the present value. What is a present value? Present value by definition is the current value of a future sum of money or stream of cash flows given a specified rate of return. That's the definition. But let me illustrate this present value for us to understand more about this, okay? In year 2015, I deposited money in the bank, 100,000. All right? And when I deposited the 100,000, I did not add more money on this account, neither I withdraw money on this account. 5 years later, it's now year 2020. Do you think my 100,000 is still 100,000? I don't think so. Let's say, for example, my money, 100,000, became 121,500. All right, so what happened to my money? It earned interest. So the difference between the 100,000 and the 121,500 is the interest. So the interest or the difference of 21,500 is the earned interest. It's the earned interest income. So after 5 years, the 100,000 earned a 21,500. Therefore, in 2020, it became 121,500. This is what you call the future value. Now, let me give you another scenario. 2020, the company received a 200,000 face amount of a non-interest bearing notes payable on 2023 in 3 years. A non-interest bearing note. So meaning to say the maker of the promissory note doesn't pay an interest. Company will receive the 200,000. The 200,000 face amount of the promissory note. How much is the present value of a 200,000 future value on 2020? Let's say, for example, this 200,000 or this prevailing rate of interest for a note of this type is 10%. The present value of one at 10% for 3 years is 0.7513. I just memorized that. Okay, that's the present value of one. All right, so what do we do? The 200,000 multiplied by 0.7513 present value, we come up with 150,260. All right, I memorized that too. So notes receivable is now 150,260 present value. All right, therefore, the difference between the present value and the 200,000 is 49,740. All right, you know I memorized that too, right? So 49,740 is your unearned interest income. All right, so this is your present value. Hope that helps you a little bit there, all right, to know about what a present value is. There's another thing that I want you to learn. So let's talk about amortized cost. What is an amortized cost? When you deduct or an amortizations on a gross amount, your balance will be amortized cost. So we have our gross balance here, or gross amount. We minus an amortization amount here. Our balance is called amortized cost. All right, and we will discuss this more when we get into the non-interest bearing note, because on non-interest bearing note, we amortize the unearned interest income. Now, another thing I want you to learn on notes receivable is the three methods of amortizations. Three methods of amortizations. We have the straight line method, we have the outstanding balance method, and the third one is your effective interest method. Most of the amortization method that we're going to use on the present value is the effective interest method. Another thing I want you to learn on notes receivable is the modes of payment. We have two kinds of mode of payments. We have the lump sum and the installment. So for installment, it can be an equal installment over the life of the notes receivable, or an unequal amount or not equal amount of payment over the life of the notes receivable. So these are the things that we have to know when we deal of notes receivable problems, okay? All right. So in real life or real business world, there will be an instances where the maker of the promissory note won't be able to pay the amount due on the maturity date. So as an accountant, what do you do? When this promissory note is not paid on the maturity date by the maker, this note is called dishonored notes. And this dishonored promissory note contains the principal and the interest. So what do we do with the dishonored note? What we do with the dishonored note is we transfer this dishonored notes into the accounts. Oh, the accounts. Oh, come on. The accounts receivable. Hey, I'm not an artist here. The accounts receivable. So when you transfer a dishonored notes into accounts receivable, the accounts receivable now will have the principal, the interest, and any fees or charges by the company to the maker of the promissory note. This is what you do when a promissory note is not paid on the maturity date, aside from suing the maker.